Hey guys, welcome to the video. Today I'm going to be talking about options and options trading and how to multiply your gains and limit your losses. So I'll be the first to say, as a broke college kid, my accounts are not the biggest. I've started with about $10,000, and leveraging my money is something that I've had to do to have big gains. When I first started trading options, I made a ton of mistakes and lost a lot of money. I've learned from all my mistakes, and now I've perfected my strategy for a very low risk and high reward plays. Over the past month or so, I've multiplied my portfolio from about $10,000 to above $20,000. In this video, I'm going to show you guys how I doubled my account using options and some of my secrets and best tips between making the most gains from options. Options are basically electronic contracts that have a specified value called the strike price and expire on a certain date, which is called the expiration date. The option contract gives you the right to buy the stock on the expiration date at the specified price that you paid for, which is called the strike price. You pay a certain amount of money, which is called the premium, to control the option to buy the shares. So essentially, you're controlling 100 shares per contract at the specified date that you want to buy it at. The way that options leverage your money is that you get to control 100 shares of that stock per contract for a much lesser price than you would buy the stock. For example, if I was to buy 100 shares of Tesla, which I cannot afford, that would be $80,000. But if I was to buy a call contract on Tesla, I could control these 100 shares for a much lesser price, anywhere from $1,000 to $10,000, depending on what the strike price you want and what the expiration date you want. Okay, let's get into some examples and strategy on how to make bank off options. So the example I'm going to be using is Facebook stock. Alright, so your account is probably not big enough to buy 100 shares of Facebook. Facebook stock is valued at $225 per share, so 100 shares would cost $22,500. Using options, though, you can control 100 shares of Facebook for only $525. So in this example, we're using the Facebook 225 call expiring on June 6th, which is just 1 week from now. This is more of an inexpensive option because of the expiry date is just 1 week from now. The reason for that is there's a time premium, which means that the farther away the date is, the more the option will cost because the more time the stock has to go up. Anyways, so in this example, this strike price is $225. So let's say that the stock price goes up to $240 by June 6th, which is the expiration date. That means you get $240 minus $225, which is $15 per share that you made, times 100 because you're controlling 100 shares of stock. So that equals $1,500 worth of gains minus the premium you paid for it, which is $525. So that equals $975 worth of pure gains. And this is only if Facebook increases $15 per share in this scenario. In this video, you can see the different prices for each one, which is you got to multiply that by 100 for the total price you're paying. So $5.25 times 100 is $525 that you're paying for this option we just talked about. So in this next example, the time premium for Facebook is a lot more. This one expires on August 21st, and this one makes the option price go up to $1,680, which is more than $525. So Facebook stock only went up to $240 in this scenario, which is the same amount we were hypothetically speaking of last time. You would have lost $180. Since the time premium is much more expensive and people expect Facebook to go much more in this over time, you're paying more premium than gains on the stock. So you're negative $180 after this trade. Okay, now that we've gotten the basics out of the way, let's talk about some strategy. My first strategy I'm going to talk about is bounce back plays. So if a stock gets hit super hard, like 50% down in one day, I love to play the bounce back. Almost every reaction in the stock market is an overreaction. So the overreaction sell-off of a stock gives us the opportunity to swing trade the stock. So the overreaction sell-off of that stock gives us an opportunity to swing trade the bounce back play. So what I do to find these bounce back plays is a lot of the time I'll go to the biggest losers for the day. Either on Yahoo Finance or Robinhood, just go to the biggest losers, and there's some stocks that are like 80% down sometime. So I love to look at those and just get a small position. If it's a bigger company, I like to place options if I have high conviction that it will bounce back. and this is just a easy play, easy money, and I made a lot of gains off this strategy. So I only make option plays when I have very high conviction on the stock. If there's a stock that I'm unsure about, that I like but I don't love, for that reason I will not place option, I'll just buy a stock, which is regular shares. But if I'm really excited about it, if I feel like it's almost guaranteed money, then I'll place option calls, so I leverage my money and just maximize my gains out of it. So the next strategy I have is the hype strategy. Okay, so this strategy, you play off the hype of a stock. For example, this week I played the hype off Canopy Growth Company, ticker symbol CGC. So what happened is Canopy Growth earnings is Friday morning. So I bought in on Tuesday, knowing that people are going to be excited about the earnings, knowing that Aurora Cannabis had just gone up more than 100%. So for this example, this was a very high conviction trade of mine. I knew for a fact that people are very excited about Canopy's earnings. So I knew that people would be buying in and getting ready for earnings. So I could just play the hype, play the gains, and just ride the wave up. And I sold out today right before earnings, which is tomorrow morning. And I made more than $1,000 off this play, just playing off other people's excitement. So my next strategy on call options is playing through earnings. So an example of this is Peloton. About a month ago, I was super bullish on Peloton. I had done a ton of research, and I knew they were about to kill earnings. So I rode the wave all the way up, and I held through earnings. And I had like 300% gain on my position because I leveraged my money, very high conviction on this trade. So let's talk about put options real quick. Put options are the inverse of call options. So basically with put options, you're leveraging your money to bet that a stock is going down. An example of this that I had was with Carvana. I had very high conviction with this put option on Carvana. I do not like what the CEO is doing with the company. The income statement is very unhealthy, very negative. The balance sheet was debt loaded. I had like no cash on it. So I placed a put option earlier this year on it, and I made about 80% on my money. I only place put options when I have very high conviction that a stock is going down. I do not like to bet against the market because anything can happen and stocks pretty much only go up, as we've seen recently with the Fed just loading up the market with cash. So I only recommend using put options when you're very high conviction with the stock going down and there's nothing going for the stock at all. Even so, it's very risky because anything can happen and any stock can get inflated at any time and your gains can be wiped out, resulting in losses. So one of my favorite things about option contracts is the most money you can lose is the only money that you buy the contract with. So for example, with that Facebook stock, which was $525, the most money that I could lose from that would be $525. And the cool thing you can do with options is you can trade them. So if you buy in to that Facebook stock and Facebook goes up 1% that day, your option contract probably increased anywhere from 5 to 10%. So you could sell out for a quick gain, which is quick, easy money, which happens a lot for me if I see a value midday in the market that I just see as unreasonable, like the market is super green and a very good stock is super red. I'll just buy an option in that contract and wait for it to bounce back midday and just sell out, which is very easy money in my opinion too. It's just an easy $100 you can make in a span of an hour or so. So option trading helps leverage your great research ideas and makes crazy gains off of them. I've seen up to 2,000% profits on somebody making a call option, and I strive to get that one day. I hope this answered all your guys' options trading questions. If you have any more questions, leave it in the comments below. I'll be sure to get back to you. And if you have any other video ideas that you want to see, any more information you want from me, leave me a comment below telling me what video I should make next. Thank you guys for watching. Let's get these gains tomorrow.